please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Ridham Desai, Head of Equity Research and India Equity Strategist at Morgan Stanley, is joining us from the sidelines of the Morgan Stanley Investor Conference. But Ridham, first up, tell us what's the mood there? Is it very positive on India? Is it, how long do we wait for earnings growth kind of mood? Just describe what people are talking there.
So it's still early for me to judge that because we're just about starting and I don't think investors will stream in for at least for the next half an hour or so. So I haven't really chatted with anyone, but the data is right in front of us, right? Foreign investors have been pulling money out of India. Their overweight position in India has declined. We're at 2011 levels. They're still overweight, but it has come down significantly. So you can tell that they have been persistently disappointed by India's lack of growth. And they're stepping aside. So I don't think I expect to hear anything different. Investors continue to be focused on bottom-up ideas, but on a top-down basis, I think they're finding a lot of other markets attractive, and therefore India has kind of underperformed all through 17. It has gone a little bit up and down. Surprisingly, in the month of May, and counterintuitively, India actually outperformed emerging markets. Let's see how that pans out. My view is that India will outperform for the rest of the year, but we can discuss that as we proceed in this chat.
This earnings growth, I mean, Lata was asking you about the earnings trajectory. This earnings growth of 15% has been a mirage for the longest time. Everyone starts the year with a 15% projection and then scales it down to single digit by the time the year comes to an end. You think this time would be the same?
So see, Sonia, that is what happened in the late 90s and early part of 2000s. Then again, it has happened for the last 7 years. We've been in a deep earnings recession. This has been the worst earnings recession in India's history. The drawdown in earnings from the top to the trough has been in excess of 20%. That exceeds previous earnings recessions. But also remember that between 2004 and 2008, analysts started the year with a forecast of 15%, but we got 30%. So, I think history tells us when the earnings cycle turns, we will underestimate the earnings. And when the earnings cycle is going down, we tend to overestimate earnings. So we've been in that kind of pattern for the past few years. Our view was 2 years ago that we may have hit the trough of earnings, but then we got hit by the impact of demonetization and then a little bit of the impact of GST, and so that view has really not panned out. So we are also guilty of having overestimated earnings. I feel now we have kind of come to a bottom. Revenue growth has been accelerating for the past 6 quarters. Even for this quarter, the revenue growth for various cuts of the market is somewhere between 12 and 15%. So that's a very robust revenue growth. What's not happened as yet is that margins have not recovered. And as I think you were discussing this on your TV program yesterday, bulk of this pressure is in the corporate banks. So if you X out the corporate banks, then I think earnings have actually inflected already in the upward direction. It's the headline number that is still a little bit short of requirement. But the underlying momentum, I think, in growth has turned. So we've been all guilty of having overestimated this. The market has been looking forward. It has not troubled the market, actually, though India has underperformed for this very reason, because emerging market growth has been superior to India.
Just a final word on this earnings bit. Do you think then this could be the year of reckoning? The year when people underestimate and things fire up, simply because, the Reserve Bank's recent circular forces the last gush of dirt from, corporate lending banks. As well, as you pointed out, the fourth quarter clearly showed consumption uptick, which was beyond many analyst expectations.
So see, Lata, I think growth is actually shaping up quite well. Government investment is approaching all-time highs. Consumption, as you rightly point out, has recovered. We're seeing a recovery in exports, and that has sustained for a while, and global growth seems to be in good shape, so there's less to worry about exports. And finally, our view is that the private capex cycle is also about to turn. We just completed a survey of 200 companies, and yesterday we published a report which suggests that going forward into the next 12 months, private capex will actually recover. And in fact, corporate sentiment, and we've been doing this survey for 6 years, is at its best that it has been in the last 6 years. So companies are actually quite optimistic about their prospects over the next 12 to 24 months. They've seen capacity utilization rise. They're expecting capacity utilization this year to be 83%. If you add another 6-7% growth, you go into the 90s. It takes 2 or 3 years for new capacity to come on stream. So very soon, on the aggregate, companies will be struggling for capacity. So they will have to put capex into place. So I would think that all the growth drivers are in place. The point is whether profits start gaining share in GDP. And again, I'm probably going of the view that maybe it has, and we're hoping and expecting that earnings growth will turn.
Okay, so if the growth drivers are all in place, Ridham, and the earnings story is expected to pick up, what is it that is disappointing foreign investors? I mean, you did start off the conversation by saying that the overweight on India has come down significantly. You think that's going to change anytime soon?
So see, Sonia, that is because on a relative basis, India has underperformed in terms of growth until now. If that changes over the next 12 months, then foreign investors will be back. So I think it may, because emerging market growth may not be as good as India. India has relatively underperformed in terms of growth. So that may change in the next 12 to 18 months, but there are lots of other issues in India which foreign investors are worried about. So it's not just about earnings growth. They're worried about politics, they're worried about oil, they're worried about a slew of factors, which I think is causing their sentiment to be a bit off color.
Actually, Ridham, I know you're the big picture, medium and long-term guy, but I mean, we are really puzzled by the underperformance of India in the last 2 or 3 days. I mean, the bipole results day, we didn't do all that badly. But Friday we fell, and Monday, I mean, yesterday was really bad. We saw Wall Street kicking up because on Friday because of good jobs data. We saw all of Asia in a blaze of green yesterday. Our underperformance just stood out, especially the mid-caps. Year to date, we are, what, 11% down on mid-caps? What's niggling this sector? What's niggling India now in the last week or two?
So Lata, specifically on mid-caps, here's the story. Last year, India's small cap index was up more than 60% in US dollar terms. That makes it the best performing index in the whole world by quite a margin. And we track about 140 odd indices around the world. So the small cap index was roaring last year. Now I think we're seeing a bit of a pullback because valuations had become quite rich. Mid-caps were trading at par with large caps. They usually don't. They trade at a slight discount. Since the last quarter of last year, we were cautious on mid-caps, and yet mid-caps were actually running away. Then we started correcting in January. That drawdown that we saw, I think, and again, I'm talking short term, didn't really complete its course. And I didn't sense that we got capitulation. So maybe now there is a little bit of a capitulation happening, and at some point in time, mid and small caps may find a trough. But I think for the rest of the year, it certainly still looks like large caps will do better than mid caps because the valuation adjustment has not yet been completed. So to my mind, it's largely to do with valuations, that mid caps had become too rich. When I spoke to investors around me, and even when I questioned myself about whether I was willing to buy a certain stock at that price, which it was trading at the end of December, the answer was, no. It just is too rich and it needs to come down. And I think that answer became a no for a lot of people. And then then the liquidity goes away, and then the force of the bid vanishes, and that's how share prices fall. So, and then it doesn't just come back to fair value, right? It usually goes below fair value, and that's what we are probably going to witness over the next few months.
Okay, Ridham, I must say your tone has become a lot more somber than what it was the last time we spoke. I remember you being one of the most bullish guys on the street.
No, Sonia. No. No, Sonia. Sonia, I will remind you, in February, we had a pre-budget discussion at the Bombay Stock Exchange.
Yeah.
You pressed me for my BSE target, and I kept saying it's a very ordinary year. No, I mean, it was a very modest return year, and that's what we are forecasting. It was, at that time, my index target was 35,500. for December, and today it is 36,000 for next June. So we're really not looking at a runaway market, even though growth is looking actually quite good. We think the market is likely consolidating in a range. Hopefully it doesn't go down a lot. It could if things turn really bad. But I think it's probably operating in this range where it goes up and down a bit all the while.
Ridham, let's take a few specific issues. How painful are higher yields? Year to date, across the curve, 1-year CPs or even 1-year G6 to 10-year, 30-year G6, yields have risen by about 140 basis points year to date. Is this very painful, or will growth overcome this as well?
So Lata, one of the striking differences between the rise in yields in India versus say the US until recently was that in the US the yield curve was flattening. So the short end was rising faster than the long end. And in India the yield curve was steepening. So the long end was rising faster than the short end. And that I think suggested that the bond markets had started to believe that growth is back and maybe there's a bit of inflation risk as we go into the second half of this year. That's not necessarily a bad picture for equities. What happens is that when this inflection point takes place, there is no doubt some volatility, which we have been experiencing for a while now. And the market is digesting these higher yields. But per se, I don't think higher yields are negative. The reason behind rising yields is more important. In 2013, when yields rose, it was because India faced macro stability risks. That was bad for equities. Today, it's not because of macro stability risks. In fact, I would actually opine that macro stability in India right now is quite the best it has ever been, which is why we are not so perturbed about rising oil from a macro perspective. The stock markets may worry about it, but I don't think it's such a big macro risk. Had this happened, say, 5 years ago, it would have already created a much bigger currency depreciation. You know, again, on the point on currency, a lot of people see the headline INR USD and think the rupee is depreciating. Last month, the rupee was the 7th best performing currency in the world. So it's not like, you know, we are underperforming on the currency because of oil. We're certainly not underperforming. So I think macro stability is good, but bond yields rising does produce underlying volatility because of the sudden rise, and that I think will persist for a while until the market has digested these higher yields. But I think higher yields are here to stay because growth is turning.
How will that change your stock picking? Do you move away from NBFCs? Do you move away from only aggressive NBFCs, only from less collateralized NBFC lending? How does it influence your stock picking?
So actually, Lata, higher yields will not necessarily impede loan growth. So in my view, loan growth is actually coming back because there is greater demand for leveraging both on corporate balance sheets as well as on consumer balance sheet. So those who have well-capitalized balance sheets, I think will be fine. What you have to worry about is the undercapitalized NBFCs. So those are the ones I think that will be vulnerable to multiple compression. So that would be my response to you. I think you need to look at the capital on the balance sheet, and if the capital is adequate, I think you know, the NBFCs will be fine.
I went through this really nice piece you had written on digital media about how to be an ace stock picker. And in that you point out certain virtues which are rare to find in this market. I mean, moat, good governance, supportive macros, reasonable price. I mean, I haven't seen that combination in a while. But you tell us, are there still themes, stocks, sectors where you can sort of get this list?
Sonia, there are always stocks in the market. Okay, 1,500 stocks trade daily in the National Stock Exchange, and every day I'm surprised to find 5 or 6 stocks that were ignored by the market, which look like they have good moat, reasonable valuations, you know, decent management. So there are always stocks for people to pick. The problem, Sonia, is you know, the size of money that you have to put to work. So if you are a high net worth investor, which I suspect you may be, then it becomes a problem, because then, you know, it may not be necessary that you find liquid enough stocks at all points in time. So that is a challenge. So, you know, for example, let's examine this point, right? Because of the successive disappointment on growth, the market has certainly ended up overpaying for certain businesses which have very high moats around them. Now, growth is certainly going to be good for India over the next 10, 12 years, and these businesses should do well. But, you know, maybe they're already priced in as far as share prices are concerned, and therefore you have to be careful, Because the road to making money is not about just buying good businesses, right? It's about buying good businesses at a reasonable price. And that's been our strategy. So do I have such businesses in the Nifty? I think there are plenty. The private sector banks, I think the auto stocks, even some consumer names, I think represent this description of businesses with good moats, decent managements and reasonable prices. So there are quite a few liquid large cap stocks that are available. In fact, I think there are more liquid large cap stocks than reasonably sized mid cap stocks in the market right now that fit this description.
Well, I would have allowed you two HNIs to take this conversation offline, where you can give her some stocks.
No,
maybe.
it's called high, higher, highest net worth individual. So there's three of us in that order.
All right. No, Ridham, so therefore you would think the accent should be on large stocks now.
Yeah, I think at least until the mid-cap valuations have entered into what I would term as attractive territory, which is say a 20 or 30% discount to large caps. And of course, I'm talking about aggregate numbers. It doesn't necessarily apply to individual stocks because individual stocks do their own thing. But I think the market has given up on growth last month. It is looking very suspicious of growth. It's anchoring itself with quality. Quality looks quite richly valued. I would worry about buying high quality, so-called high quality stocks at these valuations. I think you need to take a little bit of risk, buy cyclicals, and buy stocks that are not so expensive because there is less clarity on growth. And those may probably be the ones that will outperform in the next 12 months.
I know you don't want to comment on individual stocks, but I just have to ask you because this has become such a big issue. I see ICICI Bank in your focus list. I wanted your thoughts on what you've made of this whole Chanda Kochar issue and, if there is a cleanup, which eventually there will be, is it sort of a big positive for shareholders?
You gave me my exit at the start of that question, Sonia. So I don't wish to comment on individual stocks, but I'll make a comment on corporate banks. I think corporate banks have had a rough ride over the last 5 years. The loan cycle, which ended in 2010, has left a lot of pain on their balance sheets. I think we're nearing the end of that pain. A lot of provisioning has been done, and I think the NPL cycle may have ended. So we may be in the last leg of write-offs. And to that extent, I think a bunch of these stocks actually represent good value for investors who want to take a, say, 1-year call or a 2-year call on the market. So for that reason, we are actually quite bullish on corporate banks.
Okay. Where does politics fit in all this, Ridham? The bypolls are indicating that perhaps the ruling party will not come back with the same majority. A lot of people will tell us that we shouldn't read too much, shouldn't extrapolate. But nevertheless, hypothetically, if the market worries about it, will that be a cap or will that be overridden by earnings?
So I think, Lata, there's one big difference going into 2019 elections versus any of the elections of the last 30 years. And the difference is that the market has to deal with the possibility, and note I use the word possibility and not probability because I don't know, the possibility that the next government does not have the same strong mandate as the outgoing government. Now, that has not happened since 1985 because after 1985, the market has always gone to elections hoping for a stronger government because India has had successive coalition governments right through this period. So we all know that this was the first absolute majority government since 1985. Yeah. So there's that chance, and we don't know what that chance is. Now, depending on how the market starts factoring the percentage or the probability, I think it will affect how share prices behave. So there is a chance here that the market starts believing that we will not get a majority government and it will be a fragmented mandate. And it may even go to the extent of believing it's a fractured mandate. And if it goes to that extreme, then I think share prices will struggle. And then, of course, depending on what the actual mandate is, we'll get reaction next May. So that is clearly a problem. Now, what do investors do? So I think as far as politics is concerned, and I don't claim to be an expert on politics, there are 3 things that we observe. The first is, oddly, maybe not oddly, but in fact, not surprisingly, I should say, growth leads election results and the performance of incumbent governments by about 15 months. So we call this the force of incumbency, which is if an incumbent government needs to win, it needs to have delivered growth about 15 months ahead of the elections. So we are now, I think, entering into a kind of a growth uptrend, which augurs well for the incumbent. However, having said that, the strength of this growth cycle is not as good for the incumbent to be absolutely comfortable that it's a done deal. The second thing I think which again has affected the way the bipoles have behaved, and I think that will be a very crucial factor going into 2019, is pre-poll alliances. So two states matter there, Uttar Pradesh and Maharashtra, because these are the two states where the electorate is fairly fragmented and pre-poll alliances can swing the seats. Now remember, BJP has 94 out of the 128 seats in Uttar Pradesh and Maharashtra right now. So I think we have to be very careful about how pre-poll alliances happen, and that could have a telling impact on how election results will shape up. So I think these are the two factors.
So coming back to the forecast, which is I think easier for you to do, you said you have a base case of 36,000 for the Sensex by the end of the year. What about the bear case? Do you think the decks are stacked up for a 2008 kind of fall at all, or are we worrying too early?
Point forecasts are stupid to make actually, okay? I like to focus on the range, okay, and there is a big range here, and I have seen some comments especially in social media criticizing me for this wide range that I have on the Sensex, which goes from 25,000 to 40,000, and somebody I think said that, you know, with that type of range I'll never be wrong. But the fact is that we could be dealing with a pretty wide range going into 2019. And it could be a, it could be a year in which the market does, a fair bit of swinging up and down depending on how it starts believing the election results will be. So at various points in time with various data points, the view on the elections will change, and then the market will do its jig. Also, if you go back 30 years, on a 12-month basis, rolling basis, the Sensex on an average does about a 40% swing. We haven't had that since 2014. The Sensex has been a very well-behaved person and has not been oscillating as it usually does. So could we get could this be the year in which it does that oscillation? I think it's possible, and we could get that bit of oscillation. So yeah, you point out my forecast of 36, which I said sometime during the show. That I think is going to go terribly wrong. So keep that in mind. But I think the range is something we should work with. If things get optimistic, I think the market could go up 10–15%. But if it doesn't, then I think we could be in for a 15% correction.
Ridham Desai, always a pleasure speaking to you. Thank you for joining us.